Okay, let's take a look at another set of exercises that will help us understand the concept of relevant and irrelevant costs, as well as some others, as we go through this related material. And so we've got a couple of prior videos on understanding differential income and relevant costs and revenues and so forth. And so we're going to start, and those on our little handout here, those go 1 through 10. So we're going to start with number 11, okay? And let's see here, we've got a scenario, so let's see what they want. It says, which alternative should Tin Can Company accept, and then what is the relevant profit from the alternative? So I can already tell that we're going to be dealing with a differential revenue slash cost item, as well as sunk costs are going to be a part of this question 11, and opportunity cost is going to be a part of this question. So it says the Tin Can Company has 100,000 obsolete cans in inventory at a cost of $5,000. Okay. The cans can be cut in half to make candle holders for $1,000. That's the $1,000 what it's going to cost to cut them in half. The candle holders can then be sold for $1,750 in total. Okay, and if we don't want to do that, the cans can be scrapped and sold just the way that they are for $450. So when we talk about obsolete cans, not exactly sure what to visualize there, but that's not important. Okay. So it says, which alternative should the Tin Can Company accept? We already read that part. Well, the only way we can answer this question is if we establish what is relevant and what is irrelevant. Okay, so as we go through here and we look at our scenario, the first dollar amount that we have is $5,000, and that's what our inventory, that's what we paid for it. It says inventory at a cost of $5,000. What we need to recognize is that this $5,000 is a sunk cost, and as such it is not relevant to the decision-making process. Okay, our chance to not incur that $5,000 was before we bought the cans. Okay, well, now we've bought them, it's a sunk cost. So the cans can be cut in half to make candle holders for $1,000. So my question to you is, have they been cut in half yet? No, they haven't. So this $1,000 here is absolutely relevant, and this is a relevant cost. Okay. $1,000. All right. And then it says, because we don't have to do this, the candle holders can be sold for $1,750 in total. All right. So the only way we're going to get the $1,750 is if we make the decision to outlay $1,000 to make that happen. So this $1,750 is relevant. And you say, well, isn't revenue always relevant? Well, yes. However, we are assuming that there is a difference among alternatives. Okay, so I promise that says relevant revenue. $1,750. If the cans are scrapped, they could be sold for $450. So we can actually call this, let's see here now. We can call this alternative 1, and then alternative 2 has revenue of $450 and cost of 0. So we're going to answer this question very logically, and we're going to say that alternative 1 is better. Because yes, we're going to outlay $1,000 versus 0 here, but we get $1,750. So our net benefit is $750 versus $450. So this, kind of squeeze that 750 in there, make the 7 a little bit bigger. This is the scenario we want, okay? However, it says, what is the relevant profit from the alternative? It's this $450. So the second part of the question, the $450 is the relevant profit from the alternative. And so what we call that is our opportunity cost, because 450 minus 0 is 450, obviously. So we would make money under each of these scenarios. It is very, very important that we understand we are not focused on 5,000 plus 1,000 and then say, okay, that's our cost, and then we're selling it for $1,750. We've got a loss. I understand that. I get that. But the 5,000 is sunk, therefore it is not relevant to our decision. Okay, so we have included all of the relevant facts and come up with the fact that we're going to go ahead and cut these cans in half, make them into candle holders, sell them for $1,750 in total versus scrapping them for $450. All right? Okay. Question 12 talks about contribution margin. And contribution margin, let's see if we can figure out what the answer in this is first, and then we need to understand why it's important. So it says sales revenue plus variable cost, sales revenue plus cost of goods sold, sales revenue minus variable costs, and sales revenue minus cost of goods sold. All right. Well, we don't generally add revenue and cost together, and we don't add revenue and expense items together. So we can eliminate A and B. I want you to look at choice D for a moment. Sales revenue minus cost of goods sold is called gross profit for a merchandiser or gross margin for a manufacturer. So our answer ends up being sales revenue minus variable costs. Okay? Now this is important because remember what we're doing here. We are trying to differentiate between alternatives. So it is very, very possible that we could have a variable cost that is not a product cost. We could have freight costs. We could have sales commissions costs. We could have selling and administrative costs or advertising costs that are going to differ among alternatives. So when we're talking about contribution margin, we're talking about sales revenue minus all variable costs, which includes, of course, cost of goods sold plus any other variable costs that are incurred. So, you know, again, if we want to fully and completely assess alternatives, we have to understand the concept of what is contribution margin. So we can look at contribution margin in total, which is what we did here, and we can look at it on a per unit basis. So let's say we're selling an item for $20, right? And our cost of goods sold is 10. Well, we might, you know, our contribution margin, if I tell you that my contribution margin is $8.50, well, that means that we got a sales price of $20 per unit minus $10 cost of goods sold per unit minus other variable costs, which end up be $1.50, gives us a contribution margin. We'll call it a unit contribution margin of $8.50. Okay, I just made that up. All right. So that's why so if we have different alternatives and we have any change between sales revenue price, cost of goods sold, or any variable cost, anything that's variable that differs, we have to account for that, and that's why contribution margin is so valuable to us. Okay, question 13 says, true or false, unit contribution margin could be written as sales price per unit minus cost of goods sold minus other variable cost per unit. What do you think? Well, it seems to me that the answer is true, and I know that because that's what we just did right here. Yeah. So that is a true statement. And I think what we're going to do, let's see here, is we are going to go ahead and add one more question on here. So this video is going to get a little bit long. It says Terra produces color cartridges for inkjet printers. Suppose cartridges are sold to mail order distributors for $12 each, and that manufacturing and other costs are as follows. Okay. This is a very good question here. We have our variable cost per unit over here, and we have our fixed cost per month over here. The variable distribution costs are for transportation to mail order distributors. Okay, so we're talking about this 10 cents right here. All right, so that is a non-product cost. Also assume the current monthly production and sales volume is 20,000 and capacity is 25,000. Okay. It says if the sales price per unit increases by $2 and unit sales decrease by 2,000 units, Terra's monthly profit would, and then they say indicate whether profit would increase or decrease and by what amount. Okay, so we have to understand something. This has a lot of great information. We do not have to change course. We do not have to increase our sales price by $2 a unit. So what we need to do is focus on all of the things that would change. Okay? So because one of our alternatives is to stay the course, we have to look at that. Okay? So we're selling 20,000 units per month. All right? That's going to be important. So we're going to call the current, you know what, I'm just going to scratch this out and we're going to say current. 20,000 sales units times 12 minus 5. Simplified, this is $7. That's 140,000. All I have to do to compare this is say, okay, proposed what? Proposed increase. If I do that, I'm going to lose 2,000 units in sales, so this 20,000 will now become 18,000 units. And I'm going to multiply that by 14 minus 5. So this is $9. And so let me just show you how I did this, because I did this first one in my head and I probably shouldn't have done that. So 20,000 times what we call our contribution margin per unit, or unit contribution margin, is 140,000. Then we changed it, right? We raised the price by $2, so now we're selling it for 14, but our variable cost still $5. So we're going to say 8, but we lost 2,000 sales, so 18,000 units times 9. And that's going to give us 162,000. So what we should do is we want proposed, because we make $22,000 more. You may wonder, you forgot to account for the fixed costs. No, I didn't. No, I didn't. You see, in this scenario, I know that it's really 140 minus 25. But I'm not going to consider this 25,000 because it is not relevant to the decision. I'm going to have to subtract that same 25,000 over here. So is this 25,000 going to have an impact on profitability? Absolutely. Over here I'm going to make 115,000, 140 minus 25, and over here I'm going to make 137,000, which is 162 minus the same 25. This 25,000 does not change. You say, well, this $5 didn't change. Right, I get that, but it's the contribution margin per unit that did change. It went from 7 to 9, so we have to account for it, as we also have to account for the volume here as well. We have to account for that. So we want to go with the proposed change of increasing by $2, sacrificing 2,000 units, and we make $22,000 more. Okay, and that would be the answer. One thing I will say about this is that we do have to kind of consider, do we want to give up 10% of our current sales, because this has market share implications and so forth. So just food for thought, but quantitatively the proposed change is better.